So this has been on the minds of the market recently. Right now, the 30-year U.S. yield has reached 4.95%. So this is the highest it's been since 2007. And some of the reasons for that include the Federal Reserve signaling that rates may remain higher for longer, and as well strengthen the job market and the overall economy, which is causing inflation to remain above target. There's also the government spending as well and increasing debt. And interesting to note is that the U.S. federal government is planning to issue planning to issue $1 trillion in government debt in the fourth quarter of this year, and this is the first quarterly increase in U.S. government debt bond issues in more than 2 years. So if we just take a look at where bond yields have been, I have a chart of the Canada 10-year government bond yield. Now I'm going to switch back a little bit from U.S. to Canadian bonds. Really, the trajectory has been relatively the same, and that's that since bottoming out in 2020, around the time of the COVID pandemic, when it was reaching its height, we've seen basically just a pretty much consistent increase in bond yields over that period of time. So 10-year government bond yields around 2020 were about 0.5%, so well under 1%, and now pushing upwards at about 4%. So this is one of the biggest increases in bond yields and interest rates that we've seen in several decades, as a matter of fact. So we're going to talk a little bit about why this is important, why investors might want to pay attention to this. But before I do that, I just want to get into a little bit about how bonds work so that people can understand some of the mechanics of the system. So the way a bond works is when you purchase a bond, you're getting a fixed coupon or interest payment until the time that that bond matures. So you might be purchasing a 2-year bond, a 5-year bond, a 10-year, a 30-year. But essentially, your interest payment or coupon payment is fixed over that period of time. But bonds do trade in an open market. So the prices of those bonds will fluctuate up and down based on supply and demand throughout the time that you hold the bond. Essentially, there's an inverse relationship between bond prices and bond yields. So if bond prices rise, then the yields will drop because your coupon payment is fixed. And if bond prices decrease, then the bond yields will increase because, again, your payment is fixed. Now, for a lot of people, they find this confusing. If you buy a bond, it's not that your coupon payment is changing, but just rather if you bought a bond, say at 3% yield, and the rates on comparable bonds in the market right now are 5%, the price of your bond has to adjust to make that competitive against those other bonds in the open market. So that's why we say the yield has declined. Your payment remains the same, but the value of your bond will decline just so that your bond can be comparable in the open market with other bonds. So why have long-term bond yields spiked, or just bond yields really in general, but particularly we've seen this more on the long-term end of the bonds? Well, one is really it comes down to supply and demand. So on the demand side, the market is expecting that interest rates are going to remain high or go higher at this point. And this has a lot to do with economic data that we've been getting, as well as comments from the Federal Reserve and the Bank of Canada. So one way to look at this is if you own a long-term bond, if interest rates decline in the future, then the price of your bonds are going to increase. So there's an advantage to owning long-term bonds if you think that interest rates are going to decline. However, if you think that interest rates are going to remain flat or interest rates are going to increase, there's less of a reason to own long-term bonds. And that's especially the case because right now, short-term bonds actually provide higher yields than long-term bonds. So the 2-year bond is providing a higher yield, for example, than the 10-year or the 30-year. This is called an inverted yield curve. We've talked about that on different segments as well. It's generally not a good sign for the economy, but essentially this is how it's working is a lot of investors are looking at long-term bonds as less desirable than short-term bonds and also higher risk if interest rates were to increase from here, or really even if they're just to remain flat, then there's less reason to own them. Short-term bonds, on the other hand, they're not as volatile. The prices are not as volatile as long-term bonds. So if you see interest rates go up or interest rates go down, it has much less of an impact on the price of short-term bonds. There's also the increase in supply. So this really comes down to government deficits, government debt. Increasing government debt increases the supply of bonds on the market. So that's another factor as well. More supply essentially means lower price. But the real question is, what does all of this mean for investors? Well, for fixed income investors, this is a potential opportunity to lock into bonds with higher yields. So as well, there's the potential for price gains if investors wanted to lock into longer term bonds, because if rates fall in the near future or over the course of the maturity of that bond, you're going to get price gains out of that as well. But even on the shorter term end of the bond yield maturity spectrum, you're still getting very high yields here. As I said, the short term yields are actually higher than the long term yields right now. So this is an opportunity, at least in the short to midterm, for fixed income investors, or even long term if they wanted to lock into longer term bonds. But for the economy and for the stock market in general, and for consumers, higher interest rates and bond yields are generally a net negative. So companies and consumers are facing higher borrowing costs. We all feel the pinch of that. Anybody who's has a mortgage on a variable rate, anybody who's looking to refinance, this is a major factor. If you're a business and you want to invest in an acquisition that will require some debt, or you want to invest in a new product that require debt, the range of investments that make sense in a higher rate environment are going to be much less. So companies will essentially invest less, and it's generally a net negative for the stock market as well, as due to the fact that with bond markets potentially offering higher returns, that attracts some capital eventually away from the stock market and into the bond markets. Now, dividend stocks in particular have been under pressure in the current bond environment because they indirectly compete with fixed income for yield-focused investors. So, if you're an investor who is looking to generate yield out of your portfolio, income out of your portfolio, you have a choice between fixed income. You also have a choice between dividend stocks. Now, particularly if it's a dividend stock that isn't growing, that isn't increasing its dividend payment, a lot of investors will see those two options as comparable. So higher yields in the bond market mean that more capital will flow from dividend stocks to bonds, which will, of course, reduce prices of some select dividend stocks. So how about investing in fixed income? What types of rates is the bond market offering right now? So if there's different ways of doing this, one would just be to take the simple approach and purchase a GIC. So a GIC, a 1-year GIC right now is paying about 5.1%. A 5-year GIC is paying about 4.3%. So this is a massive increase from almost zero returns going back to 2 years ago. Now, one thing that investors do have to be cautious about, particularly when they're comparing fixed income versus dividend stocks, is something called reinvestment risk. Now, reinvestment risk is a significant concern with fixed income. And I'll just use the example of the GICs here. So if you get a 1-year term GIC, you get 5.1%, you may be very happy with that. But after a year, that GIC is going to mature, and you have no idea what rates are going to be at that point in time. I mean, rates could fall significantly. Maybe at that point in time, GICs are only paying 2%. And you have to reinvest that capital into another income investment, presumably, without having any idea of what the future rate is going to be. This is often why longer term bonds and fixed income investments are attractive to people that want a little more security and visibility of their income stream. Another way to invest in fixed income would just be through a bond ETF. So one that we've talked about a few times with people that are interested in bond ETFs is ZAG. So this is just the BMO Government of Canada bond ETF. It's about as safe as you can get for a bond ETF. These are all Government of Canada bonds, different maturities. You can see the yield here is 3.7%. So this is less than a GIC. Why is that? Well, the GIC is representing the current rate of interest, whereas a bond ETF, they hold bonds of a wide range of different maturities. So a lot of the bonds that they own were issued years ago when interest rates were much lower. Eventually, those bonds will mature, and then this ETF will take that capital, reinvest in new bonds, and if rates are still high, then you'll gradually see that yield trickle up. So one comparison here is that GICs right now are paying a higher rate, but you have far higher reinvestment risk because you don't know what the rate is going to be in a year, 2, or 5 even when those GICs expire. Whereas because a bond ETF like ZAG owns a wide variety of different maturities, you are exposed to some reinvestment risk, or they are as they're managing the portfolio, but it's much smoother. It doesn't change it doesn't fluctuate nearly as much. So how does this compare with dividend stocks, fixed income versus dividend stocks? So there's a few comparisons that I want to make here. One is that, of course, from a income security perspective, fixed income are generally safer from the perspective that dividends are not an obligation of the company. So if you own a company that pays a dividend, there's no legal obligation for that company to continue paying that dividend. Of course, there are companies with tremendous track records of paying consistent dividends and growing them. And the way you manage this risk is by investing in strong companies, but it's not a legal obligation. Whereas for fixed income investments, it is a legal obligation. But with the fixed income investment, the interest payments are set. And you also have that reinvestment risk where you don't know what the interest rate is going to be once that fixed income security matures. Whereas for dividend stocks, there are many dividend stocks that are quality companies, and they're growing their dividend over time. So the difference being that your income stream is actually increasing, whereas with interest income, it could decrease certainly if interest rates decline. So growing companies on the dividend side, if you're investing in strong growing companies that are increasing your dividend, you can get capital appreciation. You can get capital appreciation from bonds, but that's always a factor of the interest rates going up and down. And it's not something that you should expect. And you don't get any capital appreciation if you hold those bonds to maturity. Another thing is that dividend growth stocks, they can offset some of the impacts of inflation with growth, whereas although expected inflation is expected to be embedded into the yield that a fixed income security provides, any unexpected inflation is a major risk for fixed income. So very different securities here. A lot of times dividend stocks and fixed income get compared directly, and it's just a yield versus yield comparison. But if you're investing in the right companies, dividend growth stocks can provide different areas of return, including growing dividends and capital appreciation, whereas that's something that fixed income cannot do.
Okay. A good summary. Any comments, you guys?
Yeah, I just think, or go on, Brett.
I was just going to plug, we have a cash report as well, just where to park your cash for a time being, which goes over some of the options that Aaron talked about, as well as a few more. And there's a link in the description of the YouTube video.
Yeah, that's a good point.
Right.
I was just going to say, like, maybe we should eventually maybe I'll do it, but just kind of a duration segment to show or to explain kind of what duration is, maybe as an educational segment. But no, I think that you did a good job there, Aaron. Yeah, very interesting.
Yeah, it's a good summary, and it provides the juxtaposition between the growth that you can get in a dividend growth stock versus the kind of fixed payment you're getting in a bond, right? And
Yep.
Over the long term, if people eschew dividend stocks when rates rise often, but you're not looking over the next year with an investment in a dividend growth stock. You're looking where your yield can be over time. As we've said so many times, if you have a stock that is growing that dividend, you buy at a certain price, they keep increasing that dividend over time. Your effective yield, it may start at 4% or 3% or 5%. But you look back 5, 10, 15 years in the future, you can get 10, 15, 20% effective yields that you're getting on these businesses that you're not going to get that growth in a bond. So I mean that would be the two.
I think Warren Buffett's effective yield, I mean, I'm pulling this just from, the air, but I think isn't his effective yield on Coca-Cola like 50%? So every single year he is earning 50% on his initial
just on the dividend.
Yeah. Just on the dividends in Coca-Cola, which is tremendous. Like imagine.
Yeah, no, I mean, and you can achieve those type of returns with great dividend growth stocks. I mean, we've seen something along those lines.
That type of effective yield requires decades of ownership. But
of course, yeah.
I mean, if we look at Brookfield Infrastructure, when we recommended it in 2011, it was about $9.50 per unit, and it's paid since then over $20 per unit in income distributions, and it's continuing to pay a nice yield, grow its income distribution, and the stock has increased in value by several times. It's at about just under $40 right now. So
Yeah, and even on the small cap side, a company like Dynacor had no yield when we originally bought it. We had expected it to pay a dividend at some point. They instituted a dividend. It was around in the 3% range, but now, clients who bought back on the original recommendation, the effective yield is, 8-9% in that range. And we expect the dividend to increase next year, likely the year after. And so you can start, you're going to start to see a 10% effective yield over the next several years in that company. So, it can happen. It's not just a textbook example. These happen in the real world if you have a great dividend growth stock and your time horizon is 5, 10 to 15, 20 years plus, which it should be when you're investing in any good, solid growth company.